Hello, everyone. Welcome to yet another session of Wednesdays with Windrose. This time around, we are doing a dedicated session for our angel investor community. So we received a bunch of questions from them. We decided to sort of club them together and cater. So this AMA Ask Me Anything session specifically caters to angel investors. Let me quickly begin with the first question for the day. How do we decide on how much percentage or stake we'd like in a startup? Uh, there is no sort of set thumb rule to it. If you ask me, there's a wide range. We've seen angel investors take anywhere between 5% to even 40%, like maybe even less, like 1% to 40%, to be very honest. It's a very, very wide range. I know that answer really does not help. However, what we prefer is, right, talking more from a company's perspective. At an angel round, how much should a company be diluting? A general rule of thumb I would recommend is anywhere between 10 to 25%, definitely not over 25%. If the company is looking to raise money multiple times in future, then the founder holding might actually get diluted drastically. So it might be more prudent to restrict your dilution at the first stage, so to say. So, so a general rule of thumb is like anywhere between 10 to 25%. In my experience, most of the time I've seen the 15 to 20% range to be the most common. Now, again, word of caution, that is the dilution of the total round. So as an individual angel investor, you would then have to decide upon what check size you are writing basis uh, the percentage then you want to get, or rather the other way around, right? You could derive the percentage you're getting basis the check size out of the total round that's happening. So it's more also like what the value of the company is at the particular point in time, and what is the check size one is willing to write. I know I'm sort of differing answering this question because our next question is very, very relevant to the first one as well. So I'm just going to dive into that as well. How do we divide upon a fixed portfolio design? So this is a very, very important question, very less asked by the angel investors, because a lot of angel investors end up investing initially as a trial model, and it's not really a thought through process. And there's nothing wrong there. It's just how people get into investing for the first time a lot of times. And but a more prudent thing to do would be, see, as an early stage investor, an angel investor, one needs to recognize that your failure rates will be high, and that's not because an angel investor does not has a good eye, so to say, but that's just because at an early stage the company is subject to a lot more unknown unknowns. There are a lot more external factors that could hamper the growth of the company, and those external factors need not have anything to do with the company or the founder of the company or their business model, right? It could just be something changes in the regulation, chances that the competitor has raised a much larger sum of money and is willing to sort of bleed you to death. So there is a lot of risks initially which cannot be offsetted. The prudent approach there is actually to then diversify your risk and have a much larger basket of portfolio. Ideally, I would say an angel investor should have a portfolio size of 50, but at least a 30. Definitely not below 10, right? So if I were in an angel investor shoe, I would look at, okay, what is the amount of allocation I want to do to startups from my own investment sort of kitty, and would divide that by 30, and that is the check size I should write, and then decide upon number of portfolio companies I should write. So if I were in an angel investor shoes, what I do is I look at what is the total amount of corpus I wish to allocate to startups, and sort of divide that by 30, or preferably 40 or 50, and restrict each check size to that. The only reason being that, if you've, let's say, divided it by 50, then there might be companies, that, okay, your standard check size is X. Let's say, for example, as an angel investor, I'm looking to allocate a total of 2 crores to startup ecosystem at large, which would, by rule of thumb, would mean that, okay, my check sizes should be around 4 to 5 lakhs on average, right? uh, what happens is there are certain companies where I might be really aggressive out, really like it. So it gives me a flexibility that, okay, instead of writing a 5 lakh check, I could go up to 7, 8. Or some companies where I may not be fully convinced to a great extent. Ideally, I should refrain from investing in such companies. But let's say, because there are a lot of other good investors, or there are a lot of peer pressure, or for whatever reason, if you still feel like, okay, you know what, I do want to invest in it, maybe not my standard check size, slightly lesser. So it gives you some sort of flexibility there, but then it also helps you design a large enough portfolio so that it becomes resilient against external threat. So yeah, and going back to the previous question, actually, that check size would then determine what percentage ownership you would get at a particular stage of or a particular round of funding. Coming to our next question, how important do you think the sector specific knowledge is as a startup and as a VC? So there are two separate questions here, as a startup or as a VC. Speaking of startup, see, this is early stage investing that we're talking about. So of course, the founders need to have a thorough understanding of what they are doing and how they plan to execute it. So the startup, for a startup to have sector expertise is a non-negotiable, if you ask me. They definitely should have it in any case. Having said that, as an early stage angel investor, the investor may not have domain expertise, right? Again, if you're going with a wide portfolio, uh, again, they could be in one sector or in multiple sectors, but it's not really the angel investor's responsibility to know a lot about the sector. Preferably or ideally, if you are investing in a sector where you're already familiar with, that really helps. So you can bring more value beyond your check size to the companies. But largely, it is not like a requisite requirement for an angel investor to have deep sector expertise. I've known of investors who are investing just in the people out on the other side of the table. They might not know what the business model is. Of course, they will know about it, but the basis of their decision making is not what the business model is or what the sector is. It's purely how smart is the guy sitting across the table. Can you trust him? Can he execute? And does that guy know what he's doing? So as long as the startup is or the founding team is clear about what's happening and is there, I think that's all okay. Next question, and this is the penultimate for today's session, is when and how do we participate in bridge financing? That's a good question. But there is a meta question to this, right? So uh, it is, why is the company raising bridge finance? So there are typically two reasons for it at large. One is the company is raising bridge finance typically for working capital, which means, and again, in two scenarios, one is either the company is performing better than it had planned, so it's running short of cash and hence is requiring more capital and hence doing a bridge round to sort of achieve the traction before raising the next series, so to say. Or, by the way, that is the preferred side, and you should look at participating in such companies. The other side is where the company did not perform as planned and are actually looking to do a bridge round to meet its target that were earlier set. Now, there one might have to sort of dig deep into why did it not meet. Like in the current situation, coronavirus or the pandemic is a big reason why a lot of companies did not meet. So, how genuine is it? Does it make sense? So that's the question of when one should participate, and how is very similar to any other round, right? Uh, Given that bridge rounds sometimes are pure equity, or more often than not, they are actually unvalued rounds. So one would want to be more financially prudent in terms of what is the sort of structure that is being offered. And I believe the onus also lies on the startup to explain it in detail, so as to what are the features of the or the terms and conditions that on which the structure is being offered. Great. Moving on to the last question for the angel investor AMA session is, when do we decide we want to exit from a startup? Lovely. Uh, Again, two scenarios here. First one, what is it that you, like, or rather the question I would want to ask is, what is it that you want to do with the liquidity that you get from exiting the startup? So, so there are two reasons. One might want to reinvest, and the other is you might want to actually move it out of the asset class. In case of the former, if you are wanting to reinvest, my mantra is you only exit when you have a better opportunity to invest into. Otherwise, you don't exit. Period. Uh, but in case it is a matter wherein you want to actually move that liquidity that you get out of the asset class, then my answer is you exit when you get an opportunity to exit, right? Because see, unlisted equity or venture capital as an asset class is a highly illiquid asset class. So if you are in need of liquidity for any other reason, be it for reallocation or whatever, you take liquidity when you get it on the table. Of course, also be aware that a lot of time that liquidity has a premium, so you will not really get the same valuation as the ongoing round. The secondaries usually happen at a slight discount to the primary. We call it the liquidity premium, right? Because somebody else is sort of locking in their capital by giving you liquidity. Whereas if you want to just exit to reinvest, then only exit when you have a better opportunity to reinvest. Else, why else would you exit? The third case when you might want to exit is if the company is not doing good, or you foresee the company not performing or not following the trajectory that was earlier or you anticipated. In that case, again, I would say it's sort of a distress sale at your end, so you sell whenever you get an opportunity to. Great. I hope these questions gave some clarity to our angel investor community. You guys do fantastic work. I hope the community in India thrives, becomes larger, people become more excited, and we are seeing that happening. It's a fantastic time to be an angel investor, and I hope we continue the momentum. Happy to answer any more queries that you guys might have, guys or girls might have. Sorry, and yeah, feel free to comment, ask more questions in the session below. My LinkedIn, personal LinkedIn link, as well as my company's LinkedIn link, are in the description to this YouTube video. And in case you're watching us on LinkedIn, you already know where to find us. So yeah, happy to answer any more questions. Feel free to send direct messages. If you find value in the session today, feel free to like and subscribe this video.